Hey, what's up, everyone? This is Kirk here again at Option Alpha, and tonight we are going to talk about the difference between using straddles versus strangles. We're going to do something a little bit different here because I like to draw and I like to use some of these like little whiteboards or papers that we're going to do. So in today's talk, obviously, the different two strategies that we're going to look at, we're going to do both kind of looking at the payoff diagram for each of these, and then also just kind of how you use each of these different strategies, because a lot of people have questions on how to use them, when's the best time, the whole deal. So we'll get into that here in a second. So what we want to do first is talk about straddles first. And straddles are probably one of the simpler option strategies to understand because it's basically just selling an at the money call and an at the money put. So your payoff diagram looks like this. If you're going to do a short straddle, you would sell the same short strike put and call. So it would be like, in this case, you would sell the 50 strike put and the 50 strike call. Now, the beautiful thing about doing a straddle is you collect a lot of premium because those options are worth a lot of money. So by doing the straddle and by selling those for a lot of money, that also moves out the break-even point, which is why you have this kind of pyramid shape here. So you might sell a straddle for, let's say, $350 when it's doing the at-the-money options. Now, a strangle, on the other hand, is selling an option that's out of the money on either end. So you'll be selling an out-of-the-money put and then selling an out-of-the-money call option, and you're going a little bit further out, and you generally have much wider break-even points, generally speaking. But because you're going further out, you collect less money. So this option, again, if the stock is trading at, let's say, $50, you might sell the 35 strike put and the 65 strike call or something like that, right? So you would go a little bit further out on either end, and in exchange for going further out and potentially having a higher probability of success, you might then collect less money. So let's say that this strangle here collects, I don't know, let's say just $1 to use round numbers, right? So it could be different for different stocks, but the whole idea here is that when you do a straddle, you're going to go at the money, really aggressive, try to maximize the premium that you've collected. And when you do a strangle, you're going to go a little bit further out and you're going to collect less money, but you're going to have potentially a little bit higher chance of success, okay? So those are the two main strategies there, and I can barely see the screen on my end because I'm writing on this thing. So if you guys have questions as you're joining in here, please let me know in the comment section, or definitely if you want to see other strategies or techniques. Now, the way that we generally use these option strategies, just so you can see how it kind of looks with the stock chart, but let's say that, we have a stock that's just moving, right? And all we would want to do with a stock is to bracket it in some sort of profitable range, right? So that's what's different about options trading, at least the way that we do it, is that I don't care necessarily if the stock continues to go higher or from this point goes lower or sideways. Like, it doesn't matter at this point with a straddle or strangle because your break-even points are out here much further than where the stock is trading at the moment. And so all we're trying to do here at this point is just take advantage of the fact that the stock could potentially trade inside of a 70 or 80% probability zone, right? So that's what we do. We'd sell a call option up here if we're doing a strangle, right? Or sell a put option down here. And by doing this, again, you give yourself a 70%, 80%, whatever you want to build. You build out whatever probability of success level you want to get to by selling these options, right? So that's the whole idea with doing this type of strategies. You're basically forcing the market to make an extended move in one direction or another that it won't generally make over time, right? And if it doesn't, then we keep that premium 70% of the time or more, right? We've actually found in most of our back testing that we keep that premium much more than 70% of the time. So when would you want to use a strangle or a straddle? I guess that's the question that most people have all the time is, what are the best times to use these types of strategies? Well, here's what we basically say, right? We basically say that when there is lower volatility, or IVR as we define it, when there's lower IVR, you generally want to go with the strangle. And the reason you want to do that is because you just don't want to be super, super aggressive selling premium. You can go with the strangle. You can go a little bit further out. You want to maximize your probability of success. And in exchange, you're going to give up a little bit of the premium that you could collect, but that's okay. When there's higher IVR or higher implied volatility rank in the market, higher implied volatility across the board, then what you want to do is you want to go ahead and choose the straddle. So you want to go a little bit more aggressive with your type of trading strategy so that if the market does see that quick drop in implied volatility, then your potential premium is going to realize itself much quicker. Now, people have an issue with the straddle because you're selling at the money options. They think, oh, that's too risky, or you're selling an option and it's one's in the money at all the time and could be assigned. But again, go back to some of the other videos that we've done. Assignment doesn't really happen most of the time until the week of expiration. So yes, you can technically be assigned at any time, but you're collecting a lot of money up front and you're going to try to maximize that time basically, or that potential profit much sooner. So you're going to capture that profit sooner, get out of the trade sooner, manage it sooner, whatever you want to call it, a little bit faster. So you collect more, but you also get more upfront, right? Now, what other people always have questions on, and this is one more thing before we end up here tonight, is how do I convert these strategies if I'm not in an account that can trade an undefined risk position, right? So many of you might even have that question, like, what do I do if I'm trading, if I want to trade a straddle or I want to trade a strangle, but I'm in an account that has an undefined, or that doesn't allow margin, doesn't allow me to do that. So here's what we're going to do, and I'm going to try to draw this on this top half here because I'm running out of paper. My daughter keeps stealing paper from me. But here's what you would want to do. If you are trading the strangle, if that's the basis of your position, and if you're trading in an IRA or risk-defined account, all you want to do is you want to go really far out on either end, and you want to buy these wings and create what's called an iron butterfly. So again, all you want to do is you want to go really far out, and you want to buy cheap options out of the money. So you buy a cheap call and you buy a cheap put option out of the money and create what's called an iron butterfly. So it looks like a butterfly position, but it's an iron butterfly because you're basically selling a spread on either side. Same thing with the actual strangle itself, right? So when you go ahead and do the original strangle and you're doing it undefined risk, you're just going to sell a call option above the market and a put option below the market. When you want to convert this, you're going to convert it into an iron condor by buying a cheaper put option below your short strike. And then on the top side, you're going to buy a cheaper call option above your original call short strike, right? So it creates this iron butterfly position. Now, in both cases, you're going to sacrifice a little bit of premium to do this, right? For sure. But again, you can't trade an undefined risk strategy in your account, so you've got to, basically make do with what you have, right? So sacrifice a little bit of premium for the sake of basically giving yourself a position that has defined risk, right? So you know exactly how much you can make, you know exactly how much you can lose, etc. So if you guys enjoy these videos, please let me know. I'd love it. And definitely want to get some thumbs up on here. Let me know what other strategies you want to go through. I think this is cool. I enjoy doing this on this kind of chart. I realize next time I need to have much more paper available to kind of draw on and use. But again, if you guys are watching these videos, if you give a thumbs up or share or comment, I'd love to know what you guys think, and we'll definitely do more of these here in the future. So thanks, Sam, for joining in. Thanks, everybody, for joining in, and we'll talk to you guys soon. Have a great night.